So my friend texted me the other week and asked me what he should be looking for when he's looking to invest into individual stocks. I linked into Yahoo Finance, where I told him he could look up the financials of any company that he was looking to invest into. And then he came back to me and saying that there's so many metrics on the screen that it was totally overwhelming. And I realized that he was totally right. When you're looking to invest into individual stocks online, you're inundated with so much information. And so I replied with him, hey, don't worry man, I got you. And so that's where the video topic of today comes from. Now, investing into the stock market can be pretty confusing, and most people just pick stocks on a whim. But that's not how I do it personally. And so by the end of this video, you'll learn my personal strategies of how I pick my individual stocks, starting with the first step, which is doing your stock analysis. Now, there are two main ways to predict what the stock market will do. These are called fundamental analysis and technical analysis. A good way to think about this is based on a scale. Short-term day traders usually focus on the technical analysis of individual stocks. This includes looking at various charts and graphs, and they believe that they can predict the price of a stock based on the highs and lows of these graphs. But that's not how I do it personally. I'm a long-term investor, so I look at the fundamentals of the company to see whether or not the company will grow in the future. This includes the financials, the leadership team, and the brand recognition. I believe that this is where the information truly is to indicate whether or not a company will become successful in the future. The amazing thing is that most day traders still can't beat a low-cost index fund over the long term. Now, whilst my preferred method of investing is into ETFs and index funds, I do still allocate a small portion into investing into individual companies. Which brings me to the sponsor of today's video, Moomoo. I've been using Moomoo for a few months now, and it's been incredibly helpful with all the additional tools that they provide to their investors that I'll be showcasing throughout this video. And they've even been able to provide some exclusive bonuses for my viewers. So if you sign up using the link in the description, you'll receive one free AMC share and have 180 days of free brokerage trading across both Australian and US stocks. On top of this, you'll also receive an annualized 6.8% interest rate for any uninvested cash balances of up to $100,000 for 180 days, which means you can potentially earn up to $3,300 of interest. After the 180 days, a standard 3.75% interest rate will apply. It's a great way to get started with investing into individual stocks, and it's basically free money. The interest rate of 6.8% is also higher than any other high interest savings account on the Australian market today, so it's pretty much a no-brainer. So now that you've got your free stock and you're ready to invest more money, well, where do you begin? Well, if you're anything like me, it makes sense to begin with the numbers. And we call this quantitative analysis. Whenever I'm thinking about investing into a company, I always look at the numbers of that company. If the financials don't make sense to me and don't add up, then I won't invest into that company and won't do any more research. It's kind of like when you go on a first date with someone and they seem really nice at first. And it's not until you really get to know them that you start to see all of their flaws. Now, there are four main aspects that I typically look at. The first metric that most people look out for is known as the price to earnings ratio, or the PE ratio for short. The PE ratio helps investors determine whether a company is overvalued or undervalued. Now, calculating the PE ratio is incredibly easy. All we do is take the current market value per share and then divide it by the earnings per share. While the PE ratio varies amongst individual stocks, the average PE ratio in the S&P 500 is around 20 to 25 times. You can think of this as a rough benchmark. If your company trades above that benchmark, then it's more expensive comparatively, and if it trades below that, then it's cheaper. Let's take Tesla as an example. Now, using the Moomoo app, we can actually look up the PE ratio of any company that we want. So looking at the PE ratio of Tesla, we can see that the PE ratio is around 70, which is well above the benchmark of the S&P 500, which at first glance could mean that it's overvalued comparatively. But it's actually a better comparison when we compare the PE ratio of companies within the same industry. This way we're comparing apples to apples. And if we compare Tesla's PE ratio against the industry average of other car manufacturers such as Toyota and Honda of 17, then it definitely seems like Tesla is overvalued comparatively. However, Tesla's high valuation reflects expectations of high growth in the future. Whilst most people know Tesla for its cars, Tesla actually has multiple avenues for revenue growth, including energy services and the potential for robo-taxis and full self-driving. So whilst it may seem like Tesla is extremely overvalued, it seems justified based on the amount of growth potential that Tesla has in the future. The second area that's really important to look at is known as the income statement. At the top of this statement is the total revenue, which is the total amount of money that a business makes. And at the bottom is the net income, which is how much a company makes after taking away all the expenses. Every business has two types of expenses: the cost of revenue and the cost of operations. For example, let's look at a simple ice cream stand. Their cost of revenue is the ingredients that they use to make the ice cream. They can't make their ice cream without those ingredients, so this is a cost that they must incur. But the next thing they do have a choice around, and this is their operating expenses. Essentially, this factors in your wages, who you're hiring, how much you're paying them. After all of these expenses has been deducted from the revenue that you receive from your customers, this is known as the operating income. So here's my simple calculation to determine whether a company is healthy or not. Take your operating income and divide that by the total revenue times 100, which gives you the net margin. And ideally, I look for companies that have a net margin of above 15% when I'm looking at individual companies. And if you don't want to calculate this yourself, you can very easily find this piece of information within the Moomoo app itself. So once you've searched up the stock that you're researching, go to the company tab and then scroll all the way down to the financial indicators. And there you'll be able to see the net margin financial indicator. The next area that I look at, which is going to be very important, is known as the cash flow. I'm not going to spend too much time on this one because when you boil it all down, this one is pretty simple. The main thing that I look out for when I'm looking to invest into a company is if it's been able to increase its free cash flow year after year, which is money that they can then use to reinvest into the company or pay back to its investors in the form of a dividend payment. We can see that Tesla has been able to consistently increase their free cash flow year after year. A big red flag that I sometimes see is that companies that have negative cash flow, yet they're still paying out a dividend to their investors. It's simply unsustainable and the company is going to run out of cash at some point in the future. Lastly, let's break down the balance sheet. Now, this might not sound that interesting, however, this is where a lot of hidden gems are usually found. The whole purpose of a balance sheet is, as the name suggests, to balance the assets versus the liabilities. For example, I might own a house and a car, and it might seem like I'm doing really well from the outside, but when I take a look at my liabilities, I'm drowning in credit card debt and I'm 5 months behind on my mortgage repayments. So what we want to look for in a company's balance sheet is two simple metrics. Firstly, we want to know what the current assets are for that company. Now, assets can be broken down into three different categories. Current assets are things that can be turned into cash within the next 12 months. Longer term assets are things like your company headquarters, which isn't something that you would sell within the next 12 months. And lastly, companies can actually have assets that you can't physically touch, and these are known as non-tangible assets, and the best example of this is a brand's recognition. Think of brands like Coca-Cola and Nike. These brands are recognized instantly worldwide, and so there's definitely value in that. However, you can't really put a price on that, so it's known as a non-tangible asset. Next, when it comes to liabilities, all we really care about are a company's current liabilities, which is the debt that they will need to pay off within the next 12 months. With this, there is a simple calculation that you can do to help you determine whether a company is high risk or not. And that is to take the total current assets and divide that by the total current liabilities. A good rule of thumb here is that the number should be above 1. What this means is that a company is able to pay off all of its current liabilities within the next 12 months. Once again, if you don't want to calculate this yourself, Moomoo has all of this information right at your fingertips within the app itself. And it even tells you the trend of that ratio over time. Now, once we've had a good look through of all of these numbers, we next want to start analyzing the actual qualities of the company itself. and this is known as qualitative analysis. One of the first qualities that I look for is brand recognition. When I say the word Apple, most people will think about the brand rather than the fruit itself. Being a household brand name comes with a lot of consumer trust. So when they launch a new product like the AirPods or the Air Maxes, more people are willing to give it a try. The next important quality of a company is its leadership team, and this is even more important these days with social media. What the leader says or does can have a huge impact on the stock price of that company. A prime example of this is Elon Musk, where tweets he's made in the past has literally resulted in the stock price of Tesla rising or falling significantly. And the third factor that can really impact the price of a stock market is what Wall Street analysts are saying about that company. Wall Street analysts often provide ratings, which can be a great financial indicator for beginner investors when they're looking to decide whether or not to invest into an individual stock. Just look at how Tesla's stock price was recently impacted by Morgan Stanley's price upgrade, rising by a total of 10%. And the great thing is that all of these analyst ratings are available at your fingertips using the Moomoo app. You can see a range of famous Wall Street investment firms from Morgan Stanley, JP Morgan, and even Goldman Sachs. I personally find this to be really helpful because at the end of the day, it's these analysts' full-time jobs to be kept up to date with what's going on with these companies. So it's a good gauge to use against your own analysis. Almost as if you're checking your homework with your classmate to see whether or not you both came up with the same answer. So once you've combined both your quantitative analysis with your qualitative analysis and you've got the stock that you want to invest into, the last question that you probably have is, well, what's the best time to buy? And luckily, I've got the best strategy for you, and that's known as dollar cost averaging. Now, dollar cost averaging refers to a strategy of consistently investing your money every few weeks or every few months, instead of just simply lump summing all of your money into the market at one time. No one has a crystal ball to know what the stock market will do tomorrow. The best strategy that we can leverage is to just consistently invest into the stock market. Now, every time you invest into the stock market, you will need to pay a fee known as a brokerage fee, which can range drastically depending on which brokerage platform you decide to go with. Luckily, Moomoo has some of the lowest commission rates when compared to other Australian brokers, especially when it comes to trading in US shares. So if you've enjoyed the content or learned something new, make sure to hit that like button down below because it really does help out the channel, and subscribe to the channel for more content like this in the future. And don't forget to pick up your free share with Moomoo using the link below. I've already received my free shares, so I know it definitely works. And lastly, if you guys want to know what the best investment strategy is for Australians, make sure to check out this video right here.